Okay, let's unpack this. The big question today. Can NIO Inc. actually balance this really aggressive growth push with, financial sustainability?
Yeah, that's the core of it. We're diving into their first quarter 2025 results, the unaudited ones, straight from their press release that just came out June 3rd.
Exactly. And we're pulling the key insights directly from that release. NIO, I mean, they're a major player, right? Global smart EVs.
Definitely. And they've got this expanding family now, the main NIO brand, then ONVO for families, and now Firefly hitting that high-end small car market. This report is our first real look at how those strategies are playing out in the numbers for Q1.
So our goal here for you listening is to cut through all the corporate speak, the dense tables, and find the really important stuff.
What did Q1 actually look like? What worked, what didn't? And crucially, what are they signaling for Q2 and beyond?
Think of this as your shortcut, basically, getting you informed on this specific report without wading through everything yourself.
All right, where should we start? Deliveries.
Yeah, let's kick off with the delivery story. What was that headline number for vehicles delivered in Q1 2025?
Okay, so the report says NIO delivered 42,094 vehicles in the first quarter.
42,094. Okay. How does that stack up? Year over year first.
Well, compared to Q1 last year, 2024, it's a pretty big jump.
Hmm.
Up 40.1%. They delivered about 30,000 in Q1 24, so that's solid growth compared to then.
Right. 40% YOY growth is definitely notable. But looking back just one quarter to Q4 of 2024, how does it compare there?
Ah, that's where you see the other side of the coin. Q1 deliveries were down, and quite substantially, 42.1% from the almost 73,000 vehicles they did in Q4 24.
Wow, okay. A 42% drop quarter over quarter. That's steep.
It really stands out, yeah.
So what made up that 42,094 total in Q1? Was it all the main NIO brand or?
No, the report breaks it down. The core NIO brand accounted for 27,313 vehicles.
Okay.
But what's really interesting is the contribution from ONVO, the new brand, 14,781 vehicles.
So ONVO is already making a real dent right away.
Absolutely. The L60 launch clearly added significant volume straight out of the gate.
And putting Q1 into a bit more context, deliveries were climbing pretty steadily last year before this Q1 dip, weren't they?
They were. That upward trend through 2024 kind of makes the Q1 drop look even sharper. Let's see, Q2 24 was around 57K, Q3 hit almost 62K, and then Q4 surged to that, nearly 73K high.
Before pulling back to 42K in Q1.
Right. Q1 often has seasonal factors, holidays, and such, but still, that's a big drop from Q4's momentum. Suggests maybe a very strong year-end push followed by a cool down.
Understood. And they also gave us numbers for April and May, right? More recently.
They did. April was 23,900 deliveries. May was pretty similar, 23,231.
Okay, so adding those up, through the end of May, they're at 89,225 vehicles delivered this year.
Yep. And their total cumulative deliveries ever just crossed 760,000. It's 760,789 to be exact.
So what's fascinating here is you see ONVO helping that year-over-year number look good, but the sequential story is that Q1 slowdown may be amplified after that big Q4.
Exactly. It's a mixed picture on deliveries.
All right, let's switch gears. Follow the money trail. How did these delivery numbers translate into the financials for Q1? Start with total revenues.
Okay, total revenues for Q1 2025 came in at RMB 12,034.7 million. That's about 1.66 billion US dollars.
And the trend there? Similar story to deliveries.
Pretty much, yeah. Solid year-over-year increase of 21.5% from Q1 24.
Good.
But again, a substantial drop quarter over quarter, down 38.9% from Q4 24. Tracks those delivery volumes closely.
And the biggest chunk of that revenue is selling the actual cars, right? Vehicle sales.
Exactly. Vehicle sales were RMB 9,939.3 million. Call it roughly 1.37 billion US dollars.
How did that change?
Up 18.6% year over year. The report says that's mainly driven by the higher delivery volume we just talked about. But they also mentioned it was partially offset by a lower average selling price, or ASP, per vehicle.
Okay. Why the lower ASP? Is that the ONVO effect?
That seems to be the main driver, yes. The report points to product mix. As the ONVO brand, which sells at a lower price point than the premium NIO models, makes up a bigger slice of the pie, the overall average price naturally comes down.
Makes perfect sense. And vehicle sales quarter over quarter, following the delivery drop.
Even more so, actually. Vehicle sales were down 43.1% compared to Q4 2024. That really mirrors the drop in deliveries, which, again, they attribute mainly to seasonal factors hitting Q1.
Got it. Now, beyond the cars themselves, they have that other sales category. What's in there again? parts, services?
Yeah, parts, after-sales services, their power swap network solutions, used cars, and even some R&D services they might sell to others, plus auto financing. It's a mix.
How did that category do?
Actually, quite well year over year. Other sales were RMB 2,095.4 million, or about 289 million US dollars. That's up a strong 37.2% from Q1 last year.
Okay, what drove that growth?
They point to just having more users on the road, needing more parts, more services, using the power network more, plus increases in used car sales and those R&D service revenues.
It's interesting. And sequentially from Q4.
Down slightly, about 5.9% lower than Q4 2024. They said that was mainly because of lower revenues from R&D services and auto financing in particular.
Okay, so revenues track deliveries. Up YoY, down QoQ, with other sales being a bit more resilient. Now let's dig into the costs, and crucially, the margins. Cost of sales first.
Cost of sales in Q1 was RMB 11,115.2 million. That's about 1.53 billion US dollars,
Trend.
up 18.0% year over year, mostly because they sold more cars. But they did note it was partly offset by decreased material costs per vehicle.
Oh, that's a positive sign. Lower material costs.
Yeah, suggests some supply chain or purchasing improvement. And quarter over quarter, cost of sales is down 36.1%, simply reflecting the lower sales volume.
So how did that shake out for gross profit and the overall gross margin percentage?
Gross profit landed at RMB 919.6 million, about 127 million US dollars. Now that's an impressive 88.5% jump compared to Q1 last year.
Wow, nearly doubled year over year.
But it was down sharply, 60.2% from the strong Q4 of 2024.
And the actual gross margin percentage, that's the one people really watch.
Overall gross margin was 7.6% in Q1 2025.
Okay, 7.6%. How does that compare?
It's a definite improvement from the 4.9% they posted in Q1 2024. So progress there year over year.
What drove that Y improvement? Was it just the lower material costs?
That helped, but they also cited higher margin sales from that other sales bucket, parts, services, etc. Plus, an increase in the vehicle margin itself, and importantly, a reduced loss rate from their power solutions network. That's a good sign for that big infrastructure investment.
But 7.6% is still lower than Q4 2024, right? What was it then?
Yeah, it's down from 11.7% in Q4. And the report says that decrease is mainly attributable to a lower vehicle margin in Q1.
Okay, let's drill down on that. Just the margin on the cars themselves, vehicle margin, what was it?
Vehicle margin specifically was 10.2% in Q1 2025.
So better than the 9.2% in Q1 last year.
Correct. And again, they say that's mainly thanks to those decreased material costs per unit, though partly offset by that product mix shift towards O&VO we discussed.
Right. And compared to Q4 2024, it was higher then, wasn't it?
It was. Vehicle margin was 13.1% in Q4, so it dropped quite a bit sequentially.
And why did it drop from Q4, they said?
Increased manufacturing cost per unit.
Hold on. Increased cost per unit when they made fewer cars. How does that work?
Yeah, it seems counterintuitive, right?
Mm-hmm.
But it's often about fixed costs in manufacturing, things like the factory overhead, depreciation on equipment, maybe some labor costs. Those don't necessarily drop much just because you produce fewer cars in one quarter.
So you're spreading those fixed costs over a smaller number of vehicles.
Exactly, which makes the cost per vehicle go up. It really underlines how important maintaining production volume is for keeping those manufacturing efficiencies and protecting the vehicle margin.
Okay, that makes sense. So summary on margins. Better YoY due to material costs and other sales, but dipped QoQ because lower volume hit manufacturing efficiency, plus the O&VO mix effect. Now, operating expenses, R&D, and SGNA. Let's start with R&D.
Research and development expenses. They were RMB 3,181.4 million, about 438 million US dollars in Q1.
How's that compared?
Up 11.1% from Q1 last year. They attribute that to spending more on designing and developing new products and tech, plus higher personnel costs, hiring engineers, and so on, investing in the future pipeline.
But didn't R&D spending decrease from Q4?
It did, yeah. Down 12.5% sequentially from Q4 2024. The report suggests this is because different projects were at different spending stages. Maybe some big development pushes wrapped up in Q4, leading to lower costs in Q1, even though personnel costs still went up a bit.
They gave a non-GAAP number too, right?
Yeah.
Excluding stock compensation.
Yep. Non-GAAP R&D was RMB 2,914.4 million. Shows the same basic trend. Up 9.6% YoY, but down 11.5% QoQ.
Okay. How about the other big bucket, SG&A? Selling, general, and administrative. Marketing, sales teams, office costs.
SGNA expenses were RMB 4,400.8 million, or about 606 million US dollars in Q1. And here's where you see a really big jump year over year.
How big?
up 46.8% compared to Q1 2024, almost 50% higher.
Wow, what's driving that massive increase?
The main things they point to are increased personnel costs, specifically in the sales function. So more salespeople, maybe higher commissions or salaries, and just generally increased sales and marketing activities. Launching ONVO, pushing the brands, expanding sales channels, that costs money.
Definitely reflects that growth push. And compared to Q4 2024, did SGNA come down sequentially?
They did, but not by as much, down 9.8% from Q4. They said that was mainly due to less intense spending on sales and marketing activities and professional services compared to the big Q4 push. Although they still noted incremental increases in personnel costs for sales and general corporate roles.
And the non-GAAP SG&A?
Similar story. RMB 4,211.9 million, up a huge 43.7% year-over-year, but down 11.4% quarter-over-quarter.
Okay, so R&D dipped a bit sequentially, but SG&A stayed really elevated, especially that massive year-over-year jump. So how did all this add up? The revenues, the costs, the operating expenses. What was the operating loss?
The GAAP loss from operations in Q1 2025 was RMB 6,418.1 million. That's about 884 million US dollars.
How does that compare?
It's up 19.0% from the loss in Q1 2024, and it's even up 6.4% from the loss in Q4 2024.
Wait, so even though the gross margin percentage improved compared to last year, the actual operating loss got bigger?
Yes, that's a really critical takeaway here. It shows just how much impact those soaring operating expenses, especially SG&A, are having. They completely wiped out the gains made on the gross margin line.
So the cost of growth is really hitting the operating results.
It absolutely is. The scale of investment in sales, marketing, R&D, it's driving these substantial operating losses. The non-GAAP operating loss tells the same story. RMB 5,947.2 million, up 16.3% UOY, and 7.3% QOQ.
Okay, let's take it all the way down to the bottom line then. Net loss for the quarter.
The JAP net loss was RMB 6,750.0 million, or about 930 million US dollars.
From there.
Up 30.2% from Q1 last year, so a significantly bigger loss than a year ago, but actually down 5.1% compared to Q4 2024.
So the operating loss was higher sequentially, but the net loss was slightly lower. How does that work?
Yeah, and that suggests there were some positive factors below the operating line, maybe things like investment income, foreign exchange gains, or lower interest expenses, something like that, which helped the final net loss number look slightly better sequentially, even though the core operations lost more money.
Got it. Non-GAAP net loss.
RMB 6,279.1 million, up 28.1% YOY and down 5.2% QQQ. Similar.
Yeah, for shareholders. Loss per share.
Net loss attributable to ordinary shareholders was RMB 6,891.1 million, or 950 million US dollars, up 31.1% YOY, down 3.4% QOQ.
And per share, or ADS?
Basic and diluted GAAP net loss per share ADS was RMB 3.45 last quarter, Q4 24.
Non-GAAP per share.
RMB 3.01 or 41 US cents. That compares to RMB 2.39 in Q1 24 and RMB 3.17 in Q4 24.
Okay. Let's pivot to the balance sheet for a moment. Snapshot as of March 31st. How much cash did they have?
End of Q1, they reported RMB 26.0 billion in cash and cash equivalents, restricted cash, short-term investments, and long-term time deposits. About 3.6 billion US dollars.
Now, the report also included some, let's say, cautionary language about their financial position, often standard for companies still investing heavily.
Yes, it did. It noted that, NIO has had losses since it started. It had cash outflow from operations in Q1, and as of the end of March, its current liabilities were greater than its current assets. Plus, negative shareholders' equity.
That sounds concerning.
It's standard disclosure language when those financial conditions exist. It basically flags potential risks related to liquidity and funding future operations if things don't improve.
But the company has to give its view on managing that, right?
Yeah, absolutely. They followed up by stating their belief that their existing financial resources, the cash they have, what they expect to generate, credit lines, and importantly, their ability to raise more money if needed, will be sufficient to keep things running for at least the next 12 months.
Based on
their business plan, planned efficiency improvements, managing working capital better, and so on. It highlights that balancing act. Invest aggressively for growth, but make sure you have enough cash to pay the bills.
Makes sense. Okay, what else happened recently that they mentioned? Any significant developments besides the Q1 numbers?
Yeah, a couple of key things. Right after the quarter ended, on April 7th, they completed an equity placement.
Raise more cash.
Exactly. They raised about 4 billion Hong Kong dollars, issuing around 137 million new shares. That directly adds to the cash pile we just talked about, happening after March 31st.
Okay, that's important context for the cash position. Anything else?
They noted releasing their 2024 ESG report in April, highlighting sustainability efforts. And then on the product side, two big things.
Which were?
First, the Firefly brand. They officially started deliveries in April. This is their third brand, aimed at the, quote, small, smart, high-end electric car segment. And they mentioned plans for gradual global expansion.
So another new product line hitting the market. And second?
Upgrades to existing models. In May, they launched and started delivering comprehensively upgraded versions of 4 core NIO models. The ES6, EC6, ET5, and the ET5 Wagon, keeping the main lineup fresh.
Lots of product activity then. Okay, let's look forward. What did management say about Q2? What's the outlook? Starting with the CEO, William Binley.
Right. William Lai confirmed that 40% yo-wide delivery growth in Q1, but importantly, he highlighted that monthly deliveries have already been increasing steadily since Q2 started in April and May.
So momentum picking back up after the Q1 dip.
That's the message. He pointed to market share gains for their top-end ET9 and the new Firefly in their respective segments, and specifically mentioned rising demand for the ONVO L60.
Okay, so based on that optimism, what's the actual delivery forecast for Q2?
They're guiding for Q2 deliveries to be between 72,000 and 75,000 vehicles.
Whoa. Okay, hold on. 72,000 to 75,000. That's a massive jump from the 42,000 in Q1.
It really is. It would basically take them right back to, or even slightly above, the record levels they hit in Q4 last year.
And year over year, compared to Q2 2024.
That range would represent year-over-year growth of about 25.5% to 30.7%. So strong growth compared to last year, too.
What else did the CEO say?
He really emphasized that 2025 is a pivotal year for products and tech. Talked about their ongoing advancements, proprietary chips, their own operating system, intelligent chassis tech, and rolling out their NIO World model on the Banyan platform for better automated driving features, aiming for, quote, safer and more effortless intelligent driving experience.
Sounds ambitious. What about the financial side? What did the CFO, Stanley Yuqua, add?
The CFO's comments focused on cost efficiency. He stated they're aiming to achieve, quote, structural improvements in overall cost efficiency starting right here in Q2.
So directly addressing those high operating expenses we saw.
Seems like it. Signaling a push to improve operational performance and maybe start trimming some of those losses alongside the expected sales rebound.
Okay, so with that big delivery forecast and the focus on costs, what's the revenue guidance for Q2?
They're projecting total revenues for Q2 to land between RMB 19,513 million and RMB 20,068 million. That's roughly 2.7 to 2.8 billion US dollars.
How does that compare year over year?
That revenue range translates to a year-over-year increase of about 11.8% to 15.0% compared to Q2 2024.
Interesting. The delivery forecast is up to 25-30% YoY, but the revenue forecast is only up 11-15% YoY. Why the gap?
Good catch. It almost certainly reflects that product mix shift again. With a larger proportion of sales expected to come from the lower-priced ONVO brand in Q2 this year compared to Q2 last year, when it didn't exist, the overall average revenue per vehicle is likely lower, even if total volume is much higher.
Right, the ASP effect dampening the revenue growth relative to unit growth.
Exactly. And of course, they always add the standard disclaimer. This outlook is just their current best guess, it's preliminary, and things could change.
Standard procedure. Did the report include the usual background stuff about the company mission and all that?
Yeah, briefly. The standard about NIO Inc. section was there. Mentioned their blue sky coming mission,
Yeah.
the user enterprise vision focus on tech, product, services, community, and highlighted the three brands again, NIO, ONVO, Firefly. Just context.
All the legal bits. Safe harbor, non-gap.
Yep, all there. The safe harbor statement warning about forward-looking statements and risks, and the non-GAAP disclosure explaining why they use those adjusted figures and showing how they reconcile back to the standard GAAP numbers. Pretty standard stuff for these reports.
Okay, so let's wrap up this deep dive. Pulling it all together, what are the main takeaways from NIO's Q1 report and their Q2 outlook?
Well, Q1 was definitely a mixed bag. You had that solid year-over-year growth in deliveries and revenue, largely thanks to ONVO jumping in.
But offset by that really sharp sequential drop from Q4, highlighting maybe seasonality, maybe market factors, maybe just coring off after a big push.
Right. Margins showed improvement compared to a year ago, which is good, helped by lower material costs and other sales. But they softened quite a bit from Q4, hit by lower production volume hurting efficiency and that ongoing product mix shift.
And the big elephant in the room, operating expenses, especially SGNA, just soaring year over year.
Yeah, that drove continued significant operating and net losses, even wiping out the year-over-year gross margin gains. Shows the heavy cost of their current expansion and R&D efforts.
They did mention the financial situation, the losses, the liabilities exceeding assets, standard disclosure, but flags the pressure.
But they also express confidence in their funding for the next year, bolstered by that recent equity raise in April, which is crucial.
And then the outlook for Q2 as well, really strong. A massive projected rebound in deliveries and revenue.
Definitely ambitious. It suggests management is very confident that the new ONVO L60, the Firefly launch, and those upgraded models are going to drive significant demand right away.
Plus, that stated focus from the CFO on improving cost efficiency starting now, they know they need to tackle those costs.
It makes Q2 a really critical period for them. Can they hit those high delivery numbers after the Q1 dip? Can they start making progress on the cost side?
Absolutely. And looking at reports like this, it really helps you see the complex dance these EV companies are doing. It's not just about selling more cars.
Not at all. It's about managing the huge costs of developing new tech, launching new brands, building charging networks, expanding sales globally, all while trying to get towards profitability. Growth isn't always a straight lineup.
So the really fascinating thing to watch now is how quickly NIO can actually convert this expected sales surge plus any cost savings they achieve into smaller losses. Can they start bending that curve?
Especially with investments needed for OnVO, Firefly, and potentially more global expansion, still likely quite high.
Exactly. So the final thought for you to chew on. Given these substantial investments in the new brands, the ongoing big losses, how quickly do you realistically think NIO can translate this Q2 projected growth and their talk about cost efficiency into a meaningful improvement in profitability? What part of this whole picture stands out most to you as you think about their path ahead?